Are there too many bears calling for a correction in the market? That's really what we're talking about today. It's also our article on the website this morning at realinvestmentadvice.com. Right now, there's several major Wall Street firms, about 10 of them actually coming out talking about a 10% correction sometime this year. The question is, of course, will that happen? Now, interestingly, Bob Farrell once said that when all experts expect something to happen, something else tends to happen. And of course, now with all the Wall Street banks suggesting we're gonna have a 5 to 10% correction in the markets, well, maybe that's gonna postpone it for a while. Yesterday, the markets did bounce right off their 40-day moving average, which was the norm from last time, as well as investors are now trying to anticipate the bottom of the markets to buy the dip, so to speak. We saw that yesterday. Markets bounced off the 40-day, ran right back into the 20-day moving average, failed at that level. Money flows continue to remain negative at this point. We still have a MACD sell signal as well, and volume is picking up on the sell side as well. So again, the underlying breadth and strength of the market remains very weak here. The markets are trying very hard to hold on to this positive trend that we've really been in since last November. At this point, nothing really seems to be worrying the markets much, despite the fact of what's been going on with the Delta variant, the spending bills, whatever it is. Markets continue to kind of just grind their way higher on expectation that earnings are going to continue to improve. Corporate profit margins will remain high, but we've already seen economic growth beginning to slow down. Earnings estimates starting to be ratcheted down a bit by S&P. And so there is risk here that eventually we will get a bigger correction through that 50-day moving average, which brings the 200-day moving average into line. Again, that's just a 10% correction from this level. Again, nothing major, but that's certainly going to feel worse than it actually is. Now, look, if we go back in history to 1928, we can see numerous years where the market had corrections of less than 4%. It has happened previously. It happened in 2017. The maximum drawdown in 2017 was about 2.6%. Now, in every year when you had a very low volatility year, the subsequent year had much higher volatility, generally 10% declines or more. So again, while we may not get a decline this year of 5 to 10%, particularly if we can get through September into the seasonally strong period of October, November, December, likely we could finish this year out on an uptrend. Statistically speaking, that would not be out of the ordinary, but then watch out for 2022 because that's where we could see a much larger pickup in volatility in markets. So pay attention to the risk you got exposed in your portfolio. Don't really kind of get too far out over your skis. A lot of things are at risk here currently in the short term, particularly with the Fed now starting to talk about taper. And globally, we are now seeing central banks beginning to contract liquidity. So that potentially puts a lot more risk in markets over the course of the next several months. I'm Real Lance Roberts for 3 Minutes on Markets and Money. We'll see you back here tomorrow.